Insight and analysis now from Scott Wren. He's Senior Global Market Strategist at Wells Fargo Investment Institute. Scott, it's great to see you, and I think every day we're trying to make sense of what inflation data is telling us about what interest rate policy will look like and subsequently what happens to the economy. What's your current assessment?
Well, John, and you could see after those PPI numbers came out, the futures dropped, as you mentioned, a little bit higher than expected. But from our perspective, the Federal Reserve is not done hiking interest rates. They very well, could have a couple of interest rate hikes left, because if you look at whether it's the CPI data or the personal consumption expenditures, PCE, that core number is way too high, 4.6, 4.8, anywhere in that range. The Federal Reserve, if we don't see that number start to come down noticeably over the next few months, Federal Reserve is going to hike rates more. Now, could they pause in September? They probably will, but they're not going to wait too much longer than that. We'll have a November and a December meeting, and they could very well crank up the Fed funds rate a little bit more than where it is right now.
I'm not sure if we've found a way to perfectly capture or characterize this point in the market's digestion of economic change, but it does feel like even looking at the S&P 500 yesterday, when you had what was initially seen as an encouraging consumer inflation report, but by the end of the day, the S&P was barely in the green. And I think in part it was because you were hearing this buzz on the subject that you were talking about. Even if inflation is improving, that this idea of rates coming down quickly seems to be fading. Is that how you're thinking about things?
Yeah, I think, really, if you look at the Fed funds futures, and sometimes I look at those and say to myself, do I really trust that this is what the market's thinking? The market's not pricing in any sort of a hike, very low probabilities of hikes here over the balance of the year. And then they have price cuts in. I think in the May meeting is the first time we see it better than 50% probability. So for us, there's a couple of things going on. One is the Fed, as I mentioned, is not likely done hiking rates, although I would say that the market thinks that they probably are. We also think that these earnings estimates are too high. The consensus is well above where we are for both this year and next year. And then I also think, with this inflation topic, the market's expecting inflation to come off quicker. And, we all know that headline CPI is probably going to pop here a little because it dropped from 4 to 3 pretty quickly, and maybe it crawls a little bit higher between now and the end of the year. Inflation's moving in the right direction slowly, but it's still going to be a problem over the balance of this year, probably.
When I look, Scott, at the makeup of the S&P 500 since the start of July, you have seen investors shying away from some of the early winners of 2023. Technology is actually in the red since the start of July. We talked about energy finding its groove for a myriad of reasons, and it has outperformed. But you've had, groups like communication services, even some of the healthcare stocks, easily outperforming technology. I know you've talked with us about being defensively minded these days. How are you thinking about where to be invested in the market right now?
Well, John, really, we had been overweight technology, and I would say probably 7 weeks ago or something, we went from a reasonable overweight there to an even weight. So, that was good. We had held that position. That worked out for us. We've been overweight energy. It's probably 2.5 years now, and, energy's bounced a little here, but, certainly early in the year didn't do very well. But we're still technically overweight energy. We've looked at some sectors, and sector selection has been a little bit tricky over the course of the last 6 or 9 months. But we're looking at sectors and saying to ourselves, which sectors have really underperformed here? Materials have underperformed, healthcare's underperformed, and we still like energy. So really, those are a few sectors that we're looking at. We expect the economy to slow down for sure, and we certainly expect some sort of a modest recession. The timing of which is kind of tough, but probably early in 2024. So those are the kind of places we're looking. Where's the underperformance, and that might not pay off off right away, but we think when we look out over the next 12 or 18 months that those are a couple of good places to be. Industrials are starting to look a little more interesting to us, but you have to be able to look through this slowdown and maybe even a little bit of a recession first.
And so that's how you're thinking about stock sectors, but have you shifted any money just in terms of strategy ideas away from equities and into fixed income?
Yeah, we have. As a matter of fact, once again, maybe a couple of months ago or so, when we cut back on technology, we took broadly some funds out of stocks. We just felt like we wanted to fade this rally here as we got to some pretty lofty levels. So we've taken money out of stocks. We've moved it into short-term fixed income. These 3-month, 6-month, 12-month T-bills are all yielding more than 5%, and that's really just a parking spot for us because we do think we're going to have a pullback here. We have a good amount of conviction there. And so the idea is we get the pullback, 7%, even 10% possibly, and then we step back in. So we have moved money out of equities into short-term treasuries. We think also these longer-term treasuries, anything north of 4% for a 10-year treasury yield, we want clients extending duration, buying some longer maturity bonds too.